Morning. My name is Tom Culver. I'm the CEO of Pharmx, and here I have John Newbery, who is a non-executive director. He, as you may know, has previously been our acting CFO in the business. Now Zoe, our CFO, is back from maternity leave. John will be remaining in the business as Chief Operating Officer. Today, he'll go through the financials for consistency with our previous reporting. And so John will be speaking a little bit later on. A little bit of housekeeping. Can I please ask everyone to please use the Q&A? So that is down at the bottom of your screen. There is an option to put in questions, which we will address at the end. We have a couple of questions that have come through already via email, which we will also address. But otherwise, please sit back, listen, and questions will be dealt with once we get to the last slides. So, having a look at the business and a reflective view of how the first half has been, we're just looking at a few summary points before we get into a little bit of detail. So overall year-on-year performance has remained strong with uplifts in revenue and activity across all our key metrics. This has been supported by a number of things, including continued positive trends in key areas, such as beauty, vapes, and medicinal cannabis. Now, notably, investment in people and technology has led to an increase in operating costs throughout the half. However, proportionally compared to the uplift in revenue, it's a fairly minor increase. All our key initiatives are on plan. I'm happy with how the team is progressing. We have our leadership team now well embedded, as well as a number of new hires. You may have noticed, and hopefully you'll notice throughout the presentation, that we've recently launched a new brand. This is an important part of our strategic mission going forward. We've also just recently commercialized an agreement with Tonic. So we announced this yesterday. Tonic are the leading point of sale vendor in New Zealand. And this is an exciting opportunity for us as it now expands our market coverage to over 99% of pharmacies in the New Zealand region, giving us a 99% coverage across Australia and New Zealand. It also gives us access to a significant number of new suppliers and unlocks a couple of other relationships we have in New Zealand. We've completed the early termination of the revenue share agreement with Alchemy, and this completes the acquisition of the Pharmx intellectual property. It was really the final step in us taking full ownership of that business. And as a result, the board has now endorsed a program of work to enhance the marketplace services, and this will result in Pharmx operating with a single platform under a single brand. Again, a bit more detail of this later on through the presentation. As we look at our half-year results, very pleased to say that we're 17% up on revenue, 12% up on our gateway revenues, and 10% up on our market revenues. So as I mentioned, a very strong performance from a top-line revenue growth, and also a clear demonstration of activity across both our core platform and then marketplace being our latest platform. We've seen a steady control of costs, so EBITDA is steady. Our costs are well controlled despite our continued investment, and we maintain a very strong cash balance. So introducing the business and giving a little bit of an overview for those who are new to Pharmx, we are ANZ's largest pharmacy network. We deliver critical infrastructure that supports the entire pharmacy industry. We're the most reliable integrated ordering network used by 99% of the region's pharmacies, and we now process over $20 billion worth of orders. We work with all the major wholesalers and suppliers, giving access to over 80,000 SKUs. We partner with all the major POS vendors, government agencies, and other ordering platform intermediaries to give full coverage of the entire industry. Ultimately, we sit in the middle of the industry as the connective tissue that allows all ordering and inventory to flow. We hold a very dominant position in the market. 99% of pharmacies see our offering as high quality, 76% rated as either good or excellent. We've got very strong brand metrics with a 93% awareness rating across all of Australian pharmacies, and 80% of pharmacies see our ability to integrate our products and our solutions as a critical point of difference. We've also recently tested some of our growth opportunities with these cohorts. And again, we have very strong approval ratings from our customers, with 85% of them saying that there's a strong appeal in what our forward-looking plans are. We're also supported by some great favorable market conditions. We have a growing population, which leads to an increase in the potential number of customers that move into the pharmacy network. We have an aging population, looking to double the number of people over 85 by 2041. And increasingly, we have an unwell population. Now, obviously, that's not happy news, but it is news that drives the pharmacy agenda and the pharmacy story and continues to lead to strong growth going forward. We've also seen a recent change in scope of practice within the pharmacy network. As you know, anecdotally, some of you may be aware that pharmacies now do a lot of new things. They're in a position now where they can provide vaccines, they can do other services. There's changes around prescriptions and dispense, all which are lifting the opportunities and the role of the opportunity for the pharmacists within the community. These extend to a number of other areas, including change in vaping legislation, where pharmacists are now the only ones who can sell nicotine-based vapes over the counter in Australia. And then also they're responding well to things like the trend in wellness, whereas Australia is now top 10 spender per capita on wellness products with an average spend of about $5,000 a year. Supported by this, we also see a huge shift in changing trends around technology. As most will be aware, technology is an efficiency driver, and we're now seeing that evolution come into the pharmacy market and the supply chain market. There's a trend towards tech-enabled workforces, creating efficient, optimized work practices. We're seeing this move into supply chain, looking at optimization, predictive and automated capabilities. And then we're seeing an upgrade in technology systems across the entire industry to streamline these processes and allow the industry to scale. Summarizing these, we look at these as our competitive advantages. You know, the fact that we're the industry's first choice. We've been around for 18 years and we operate with very strong metrics across the large majority of the industry. We ultimately give access to the biggest network. So if you want to trade with pharmacy, we are by far and away the biggest and best network to do that. We have whole of market independent technology. We are modern, cloud-based, and we deliver high availability, stable, secure, and scalable systems. We've got extensive data and analytics capabilities. And our view, having visibility of the entire supply chain, gives us unrivaled insights. We've got the most products in one place. And as we just mentioned, we've got strong digitization and consumer tailwinds, which are driving the business forward into the future. Now, as we think about what that means for our business, as I mentioned, our business has been around for 18 years. We already operate with 99% of the market. So the question often comes, well, how does this business grow? As we look at the opportunity within our spaces, particularly across Gateway being our core solution, as well as our new products around marketplace and analytics, without even taking into account our opportunities for internationalization, vertical integration, and moving into new verticals, we see a huge amount of headroom within our core business as well as our other businesses. This can easily be understood by understanding the relationship, particularly with our Gateway product, between our number of pharmacies and suppliers, giving a huge amount of headroom for us to grow into despite being mature. With our marketplace business, there is ample opportunity for us to grow significant revenues within that business in a relatively short period of time without cannibalizing our Gateway products. Similarly, analytics is a complementary service to everything we do in marketplace and Gateway. It also provides ancillary opportunities to provide services directly to our suppliers, our pharmacists, and to third-party customers. And then just wrapping up for kind of the overview of Pharmx. We've gone through this before with our growth strategy, but just as a reminder, and for those who are new to our business, our FY25 strategy centers on developing new solutions to increase the number of suppliers across the Pharmx network. This in turn drives engagement from pharmacies, increases volumes, and enhances both our analytics capabilities and grows our addressable market. We support these activities through some traditional activities such as direct sales, but also through brand enhancement, through targeted marketing efforts, all underpinned by our growing team and our strong talent and our increasingly quality technology. Now, as we look back at the half year and just drawing on some of the key highlights, as I've mentioned, rebranding. This is a refreshed brand identity that reinforces our commitment to delivering confidence and convenience to the sector. The launch of our analytics platform. This is the first time this business has had an outward-facing analytics platform that can deliver solutions to customers. This drives both efficiencies in our customers' businesses. Our goal is to make their businesses better, help them grow, make better decisions, and reduce costs. And then internally, opportunities for us to enhance our products, but also enhance our business. As I mentioned, we've recently signed the partnership with Tonic. Tonic's the dominant provider of pharmacy POS and dispense software in New Zealand. They have over 900 pharmacies. This now gives us access to nearly 7,000 pharmacies across the region. They currently operate with about 50 suppliers on their own EDI gateway. However, under this partnership, we will have the opportunity to migrate those customers onto our EDI platform. And it also opens up other opportunities with existing suppliers that we already work with in the market through other partners and banner groups. This has the opportunity to increase our supplier network by well over 200. We're already nearly at 170, so adding these other opportunities on, heading towards a goal of 300 suppliers over the next coming years, seems very viable. The Alchemy termination, this early termination of the revenue share agreement now enables Pharmx to invest more fully into the next phase of the marketplace growth, and this leads us on to single platform. As part of a broader program of work, the board's endorsed a proposal that will offer more value to our customers and enable us to maximize growth and deliver more efficient scale. This is done through developing enhanced marketplace services as part of a single platform, ultimately fully integrating the EDI and data solutions and operating under a single, more efficient brand. As I mentioned at the top, the business is performing well year on year. We've looked at the top line of our revenue, but digging a bit deeper into our platform metrics, performance remains strong, and we're seeing uplifts across all of our key metrics. As we look at our growth activity, we've seen a 10% growth in total suppliers, a 4% increase in our account activity for our gateway, and a 6% growth in our activity on marketplace. As we look at how this translates into volumes, the story is stronger. We have a 14% increase in the number of orders and an 18% increase in the invoice value. Now, this is an indication of some of the tailwinds that we talked about and some of the trends that we're seeing in the industry starting to come through within our order volumes. So even with account growth, our order volumes and order numbers are increasing proportionally more rapidly. As we look at our marketplace, again, seeing very, very strong numbers continuing from our last update, a 751% increase in order value, 230% increase in number of orders, and over 150% increase in average order value. So we are seeing more people order more often and ordering higher amounts. As we look at our trends, we've seen an almost 30% increase in invoice value across our New Zealand suppliers, and we expect this to continue to grow with the announcement of Tonic. We've had an over 400% increase in invoice value in our key vape suppliers, 24% across medicinal cannabis, and almost 400% across key beauty suppliers. So again, identifying those key areas of growth are continuing to be strong. At this point, I'll hand over to John to talk through our financials.
Thank you, Tom, and good morning, everyone. As Tom mentioned earlier, I'm pleased to be able to present some details of what are another set of strong financial results for Pharmx for the 6 months ended 31st of December 2024. I'm also pleased to let you know, as Tom mentioned, that Zoe's has come back from maternity leave, and she'll be presenting the full year results in August. Unlike previous periods, the results I'm going to talk about today are much cleaner and significantly less impacted by abnormal items, such as the costs of the Pharmx legal case with Fred IT or the sale of the pharmacy software business. There are, however, some impacts on the prior period comparisons and the cash flows during the current half year, but I'll talk to these in a short while. So turning to the results for the 6 months ended 31st of December 2024. Revenue from operations for the half year was $3,773,000, up 17%, as Tom mentioned, on the prior comparable period. Total operating costs were $2,730,000, which is $575,000 more than in the same period last year. As Tom's mentioned, this increase in operating costs is driven by our investment in resources, specifically development resources, marketing capability, and IT infrastructure to rebrand and reposition the business. Personnel costs before capitalizations have increased by 45% compared to the first half of FY24 to $2,097,000. Marketing costs have increased by 155% to $166,000, and technology, communication, and cloud costs are up 28% to $258,000. Of the $2,097,000 of people costs, $655,000 was capitalized as research and development expenditure in the half, of which $285,000 is expected to be recovered under the government's research and development incentive scheme. EBITDA for the half year was $1,043,000. The prior period was $1,080,000. This is a strong performance given the previously mentioned ongoing investment in people, marketing, and IT, and the fact that the result for the comparative period benefited from the allocation of some overhead costs into the pharmacy software business prior to its sale in the first half of last year, and is better than I indicated during the last full year results announcement. Amortization and depreciation for the 6 months was $641,000, which has increased from $578,000 a year earlier. This is due to the ongoing investment in product development and capitalization of those costs. Income tax expense was $224,000 compared to $170,000 in the prior period. This all gives rise to a net profit after income tax for the half year of $155,000. In the 6 months to the 31st of December 2023, the loss was $1,732,000, which was after $66,000 of legal costs relating to the now settled dispute between Fred IT Group and Pharmx, and $1,968,000 of loss on disposal of the pharmacy software business. As Tom has mentioned, on the 4th of December 2024, the group executed a deed to terminate the revenue share agreement with Alchemy relating to the acquisition of the Pharmx intellectual property. This resulted in a reduction in the amount payable under the agreement of $824,000. As this liability related to the original maximum amount payable for the intellectual property, the $824,000 was netted against intangible assets where the original asset was recognized. Moving on to cash flows. In terms of operating cash flow, receipts from customers for the half year were $4,192,000, up 27% on the comparable prior period. However, statutory operating cash flow was an outflow of $8,909,000, which included the payment to Fred IT of $9,898,000, which was made up of the original judgment sum of $8,128,000 with an additional $1.77 million relating to the costs and interest payable in accordance with the final orders issued by the Victorian Supreme Court on the 8th of August 2024. This payment is the final payment in relation to this matter, and no further amounts will be paid. Excluding this payment, the operating cash flow was $990,000 or $128,000 when the net research and development incentive proceeds are excluded. A positive result given the investments that have been made in the first half of the year that I've previously talked about. In the prior comparative period, after adding back fund outflows relating to the pharmacy software business prior to its sale of $214,000 and one-off legal costs of $66,000 relating to the Fred IT matter, the underlying cash flow was $2,216,000. or $553,000 excluding the research and development incentive received. The $1,663,000 of research and development incentive received in that period related in part to the pharmacy software business that was sold during the half. The positive operating cash flows, together with the deferred consideration of $1,255,000 received in the half from the sale of the pharmacy software business, have been used to fund the ongoing investment in new product development during the period of $655,000 and to settle the final balance owing to Alchemy of $269,000. The prior year investing cash flows included investment in research and development of $1,080,000 and the receipt of net proceeds from the sale of the pharmacy software business of $3.35 million. Financing activities in the prior period related to the return of the capital that was paid in December 2023 of $4,483,000 and financing charges of $59,000 in the current half year relate to the lease payments. So although the cash position has decreased from $13,136,000 at the 30th of June 2024, principally as a result of the payment of nearly $10 million to settle the Fred IT legal matter, we have ended the half year with a very healthy almost $4.5 million. This provides us with the ability to continue to invest in the resources required to accelerate the proposed trajectory of growth. Thank you, and I'll now hand back to Tom.
Thank you, John. So I'll take you through in a little bit more detail some of the initiatives that we've seen in H1, and then just give you a little bit of an insight into kind of our H2, our core H2 initiatives. So starting with branding, our opportunity here is around maximizing the brand equity that we have in the Pharmx brand. As some of you will know today, we have the Pharmx brand, we have the Pharm Exchange brands, we have made mention of Pharmx Analytics. We are looking to leverage more purposefully the Pharmx brand, which is known, understood, and well liked in this industry. So this is around reinforcing our market leadership. This refreshed brand not only helps us instill that brand equity or leverage that brand equity, but it also communicates our commitment to delivering to our core customer, so our pharmacies and our suppliers across the ANZ region, and focusing on confidence, convenience, and trust values that we know resonate with these audiences. This is also about a greater strategic alignment within our business and with our customer. Our updated positioning as part of the rebranding process, "You're in safe hands with Pharmx," reinforces that patient-centric approach and aligns with our customers. It supports our long-term business growth agenda, and it simplifies how we present our products and how we present our business to market. Ultimately, this ensures continued success and growth and demonstration as a market leader while delivering both customer and shareholder value. Pharmx Analytics. We've spoken about this a couple of times now through previous updates. I'm happy to say we are now launched and in market with an analytics platform. This is delivering data and analytics through AI. It is a reliable, secure platform. It is the most modern AI-supported platform that's been built to scale. We have the deepest and most broad data set in ANZ, and we believe we have best-in-class security and privacy and control over data and insights that we are able to display with our customers. We are looking to drive growth by adding customer value, so improving our customer businesses, whether it be pharmacy or supplier or vendor or third-party agencies such as government agencies or external agencies. We're increasing supplier and pharmacy engagement, and ultimately for our business, it creates a new revenue stream. Now, our single platform. This is a fully integrated, consolidated Pharmx platform that significantly improves customer experience, and it creates technology, growth, and resource efficiencies to scale Pharmx into the larger market opportunity, which I discussed earlier. This genuinely creates more value for our customers, our suppliers, our pharmacies, and our vendors by modernizing technology, by simplifying technology, by giving more capabilities and control and self-service opportunities, particularly to our supplier and pharmacy groups. It allows us to operate on a more efficient business model, moving ourselves to more of a SaaS-orientated self-service type model, again, particularly for new suppliers and new pharmacies. Ultimately, it supports our partners in being able to deliver the changes to the ordering processes that pharmacies want. Our recent research across the pharmacy network indicated that 70% of pharmacies want to change the way that they order today. Our role as a key network provider enables to work with these partners to deliver that change. The single platform more purposefully leverages the Pharmx brand, and it reduces customer confusion of our brand propositions. Importantly for our business, it creates a pharmacy engagement point. Currently, pharmacists are our customers, but there are low touch points with our technology. It modernizes our solutions and it reduces our risk, and it leverages the scalable integrated data capability which we have invested in. The first step in single platform is our enhanced supplier portal. This is currently in testing, and we anticipate will be live within the next couple of weeks with new suppliers. This is a game-changing proposition for our business that has been around for 18 years and has done things in quite traditional ways. What we are now creating is a step change in how suppliers can engage with our business, both in speed for first engagement with new customers, but also capability with existing customers. So we are going to be the fastest and most efficient way for a supplier to connect and do business with 99% of the ANZ pharmacy industry. We are enabling or supporting onboarding of new suppliers, which currently takes anywhere up to 12 weeks to be able to onboard and trade with this market in as little as a day. So an enormous change by modernizing our technology and our approach. We've upgraded tools to help suppliers manage and grow their business, including product catalog management, order fulfillment, pharmacy connections, and performance insights. And we will slowly be introducing more and more solutions for those suppliers before we move on to new solutions for pharmacy. And as I've mentioned, upgrading and revolutionizing ultimately the way that our marketplace interacts with both the market and with our internal systems. So to close, year-on-year performance remains strong with uplifts in revenue and in activity across all our key metrics. We've continued to be the dominant independent network in the region, and this has been further cemented with our New Zealand expansion through our Tonic partnership. We have a strong strategic growth agenda supported by tailwinds, strong forward-looking strategy, and a well-governed expert team. Our initiatives and KPIs are currently being delivered to plan, and we expect this to continue. We have an unrivaled insights capability. We have well-managed costs resulting in growth uplift, and we have a strong balance sheet. Thank you, everyone. At this point, we will move to questions. Thank you.
Thank you, Tom and John. We do have a few questions that have come in on the Q&A function. Again, to all participants, if you would like to ask a question, please use the Q&A button at the bottom of your screen, and we will endeavour to answer as many as possible. So starting from the top, question one, are you able to provide any further context on the timing of you reaching what you call the obtainable market share?
I can give, we're going through a technology change at the moment. So we are obviously talking about platform change, and we are talking about moving into new markets. That said, we are fairly aggressive in what we think the opportunity is and our position to maximize that opportunity. So as we look at particularly the obtainable markets figures that we showed in the previous slides, we're anticipating that we are looking to achieve these in the next 3 to 5 years.
All right, thanks very much. The other question is, I'm not entirely sure what it means. So if this doesn't mean anything to you, then can the person who asked it please clarify? It says, please outline the shift of Pharmx platform towards beauty products, suppliers and retailers in ANZ.
Yeah, I mean, I wouldn't necessarily say that this has been a shift for our business. This goes to the broader strategy around suppliers, the diversification of suppliers, and the response to the changing attitudes and needs of pharmacies and their customers. So ultimately what we're seeing in this marketplace, and this is being driven, probably by some of the larger banner groups, and it's the same effect that we've seen in UK markets with Boots, for example, or in the US through Walgreens. The pharmacist is no longer just seen as the local community dispensary point. The pharmacy is now increasingly being seen as the provider of key and core retail products. And so this means that pharmacists are continuing to diversify their stock, and this is continuing to increase into key areas such as beauty. There are a number of other areas that pharmacists increasingly look at, whether that be technology, clothing. If you're a pharmacist based in a beachy area, you will sell hats, sunscreens, beach toys. Just like if you're a pharmacy in a rural area, you will sell other services. But what we are seeing is general trends around things like medicinal cannabis, vaping, beauty, technology being another key one. Now, what this means, and I think this is reflective in some of the metrics that we showed as well, is that we are increasingly seeing pharmacies diversify the number of suppliers that they're looking to operate with. Now, that drives directly to our business model. We generate revenue based on the number of connections between a pharmacy and suppliers. So if a pharmacy uses more suppliers, we generate more revenue from that supplier through our account-based model on our gateway. We're also seeing that pharmacists are starting to order smaller amounts of product, so holding less inventory, but ordering more often, so smaller orders from a broader range of suppliers, which speaks to this diversification at the pharmacy side, but also goes to our strategy of bringing on new direct suppliers and diversifying the range of supply that's available to pharmacies.
All right, thanks very much, Tom. Next question. So congratulations on the strong revenue growth for the first half. Can you break down the constituents of that growth in more detail?
I assume this question is, how does it break down across our different platforms from gateway to marketplace to analytics? As we've said previously, we don't report on the breakdown of those platforms. We've provided clear guidance on how those platforms are performing through the metrics we've disclosed. As we're also moving to a single platform, we don't anticipate breaking down these revenues in the future. Our guidance previously has been, and it remains so, that until those businesses generate more than 10% of our overall revenue, we won't disclose the underlying revenue lines.
All right, thank you very much. Okay, so next question. Can you explain the way Pharmx monetizes transactions with suppliers and pharmacies?
In simple terms, for the purposes of this call, through our gateway platform, we monetize through account fees. So if a pharmacy has an account with a supplier and they order through that supplier in the month, that supplier pays us an account fee. Through our marketplace platform, it's a commission-based revenue. And through our other services, such as analytics, which is a software as a service model. So we essentially charge per scope of work and per reports that we deliver. We also generate additional revenues through marketing support capabilities and technology support as well.
All right, thanks so much. Just a few more here. Next one. So is the final goal to displace the POS systems so that marketplace becomes the only software that a pharmacy needs?
What we know from the pharmacy market is that pharmacies want change in how they order. However, saying that, we see our role to continue to be that intermediary that makes all of our customers' businesses better and drive more volumes. So at this point, we don't anticipate that the point of sale vendor would not continue to be one of our core relationship partners, just as we would never anticipate that the wholesalers would never be one of our core customers. We're here to service those industries and continue to play our role. I think you also need to understand as well that the point of sale vendors will always have a function within the industry, particularly when it comes to the regulated nature of prescription-based medications. That is not something that we intend to service through marketplace or EDI gateway. In fact, understanding the history of our business, we sold our point of sale services a couple of years ago and stepped into the more efficient area of our business, which we see today, which is Pharmx.
Okay, next question. What is the incentive for a supplier to go through the marketplace? Why would a CSO wholesaler want to switch their transaction volume to the marketplace, knowing they will have to pay a much higher fee compared to the current gateway?
So we have a CSO wholesaler operating both on our gateway and our marketplace. the basic rationale for anybody to use the marketplace is an improved capability around distribution. So the fact of the matter is that when suppliers operate our marketplace, they want to be able to promote product. They want to be able to run promotions at end of stock. They want to launch new stock into market, and ultimately they want to grow their market share. Being able to do this through a digital distribution network is far more efficient for those businesses than attempting to do, boots on the ground strategy, which is driven today. The rep strategy is strong, but has its limitations from scale. It's easy to operate with, say, 1,500 to 2,000 pharmacies, but if any business wants to scale beyond that, they need additional ways to distribute. That is ultimately what the marketplace provides for those suppliers.
Okay, so we have a few questions here, the remaining few that are quite similar. So I'm going to combine them into one. And it says, Pharmx has a few competitors, including Directo, with much higher revenues. How do you plan to tackle competition?
I mean, I'm not sure we can really discuss the genuine revenues between the two businesses, as we have very different business models around what is genuine revenue versus gross transaction volume. But putting that aside, we see Directo as, an important part of this market. We also see this market having a lot of opportunity to work with different segments. So, obviously we're aware of Directo. We talk with Directo. Directo use some of our gateway services in order to process their business. They are a customer of ours, as they tell most people. So we don't see them as a threat. We see them as part of the market evolving.
Okay, thanks, Tom. That is all for the questions we have here. Unless there are any others that you want to read out from some you may have received previously, I will hand over to you for closing remarks.
Thank you. Yeah, we had some other questions that came through, particularly around the market opportunity and our potential for growth into markets. I hope, what we have talked about today, particularly in the addressable market slide, that there's probably a greater understanding of what the opportunity here is for our business, particularly as we grow over the next 3 to 5 years. I think what is also worth noting at that point is that, as we've talked about today, it requires a modest amount of investment. And again, I stress the word modest here. We're very conscious of controlling costs. We're very conscious of our position in market means that we have the luxury of being able to control the pace at which we need to develop. And it allows us to achieve quite a significant uplift and change in revenue profile of this business in the longer term. So despite there being competitors, despite our business being mature, there is a significant amount of headroom for our growth. And we think we are in the best position of which to achieve that growth. So I think as you think about the profile of this business over the coming years, our revenues will continue to grow, as we have stated today and in previous updates. Our costs will continue to increase for the short-term period until our costs start to flatline and our efficiency in our business starts to increase. And I would imagine in, a few years' time, this business will start to look very, very different from what it does today. So that was it from questions from our side. So assuming no other questions have come in, I thank you everybody for attending and thank you for all the questions that have come through. And we will leave it there today. The recording will be posted and shared. And obviously you can reach out to us via the email below on the screen, investor.relations@pharmx.com.au, or come to me directly if you have any questions or want to discuss anything further. Thank you.